Okay, it's another Fed Minutes day. Let's do some reading. And I said in the last, during the press conference, that it would be interesting in the minutes to see what their commentary was around reverse repo. So the staff had some comments and participants had some comments about reverse repo. Usage of the overnight reverse repo facility reverse repurchase agreement, but I'll just call it the reverse repo facility, continued to decline over the period. The decline in usage primarily reflected money market mutual funds reallocating their assets to treasury bills and private market repo, which offered slightly more attractive market rates relative to the overnight repo rate, amid continued increases in net treasury bill issuance and Federal Reserve balance sheet reduction. I think that's it for that column. Yeah. Credit quality, this is interesting here because we see commercial real estate spoken about twice. Credit quality remained broadly solid but deteriorated further for some sectors in recent months. Delinquency rates on non-farm residential CRE bank loans rose further in the third quarter. Delinquency rates for construction and land development as well as multifamily loans ticked up. After increases over the first 3 quarters of the year, delinquency rates for loans in commercial mortgage-backed security pools edged lower in October, but the large volume of loans scheduled to mature over the next few quarters suggested that delinquencies would likely surge again. Look at that word, surge again, not increase, surge again. We will see more of this a little later on. Here's the staff economic outlook. The economic forecast prepared by the staff for the December meeting was broadly similar to the projection for the previous meeting. Staff continued to expect that GDP growth would slow markedly. I highlighted that in a different color because that's a pretty aggressive adjective. Markedly, slow markedly in the fourth quarter from its outsized third quarter rate, but that adjective, it's not an adjective, it's an adverb. It's an adverb. Forget I said adjective there. An adverb, anything with an ly. In the fourth quarter from its outsized third quarter rate, but that economic growth for 2023 as a whole would still be solid. The lagged effects of earlier monetary policy actions through their contributions to continued tight financial and credit conditions were expected to show through more fully in restraining economic activity in the coming years. Not in 2024, in the coming years. Real GDP was projected to increase more slowly than the staff's estimate of potential over the next 2 years before rising in line with potential in 2026. It is important to point out here that the staff economic outlook has not been right yet. So, they're suggesting below trend growth for the next 2 years. They haven't been right yet. The unemployment rate was expected to be roughly flat through 2026 as the effects of below potential output growth were offset by the effects of further improvements in labor market functioning. The staff revised down their inflation forecast, reflecting lower than expected incoming data, including the November CPI and Producer Price Index, and their judgment that inflation would be less persistent than in the previous projection. And now we're on to the participants. These are the voting members. They're voting and non-voting, but they're your central bankers here. Regarding the economic outlook, participants generally judged that in 2024, real GDP growth would cool and that rebalancing of the labor market would continue, with the unemployment rate rising somewhat from its current level. Now, it's important to point out that the participants really haven't been right either. Based on better than expected data on inflation, better than expected, see, they didn't expect that. Based on better than expected data, participants revised down their inflation projection for 2023 and to a lesser extent in subsequent years. So they're not leading the data and then the data falling in line with their forecast. They're chasing the data. Which, to be fair, forecasting is brutally hard to do because the future is both unknown and unknowable. Participants judged that the current stance of monetary policy was restrictive and appeared to be restraining economic activity and inflation. In light of the policy restraint in place, along with more favorable data on inflation, participants generally viewed risks to inflation and employment as moving towards greater balance. In their discussion of inflation, all participants observed that clear progress had been made in 2023 towards the committee's 2% inflation objective. Those are some strong words, clear progress. All through 2023, in every press conference, that's what Powell was saying. We need to see clear progress towards our goal. They're acknowledging, hey, we've seen clear progress. Participants observed that inflation remained above the committee's objective, and that they would need to see more evidence that inflation pressures were abating to become confident in a sustained return of inflation to 2%. I think for the next two meetings, I think they would be on hold. And if inflation, January, February data, and even maybe the March data come in line and is still moving down towards their goal, I think the third meeting, you could have a live meeting in terms of a cut. They observed that progress had been uneven across components, with energy and core goods prices falling or changing little recently, but core services prices still increasing at an elevated pace, meaning more than their 2% target. Several participants observed the ongoing rebalancing of labor supply and demand would help reduce core services inflation. Several participants assessed that housing services inflation would fall further over time as the earlier deceleration in rents on new leases continue to pass through to broader rent measures. Later on, when they talk about the labor market coming into better balance, they do mention an increase in the participation rate, however slight, it has been an increase, and increased immigration. Well, you do have a housing shortage in the U.S., not to the extent that Canada has it, but you do. So if you solve the labor market, bring the labor market into better balance by bringing in or raising your levels of immigration, you put more pressure on rents and housing prices. And as we saw with Case-Shiller last week, housing prices are at an all-time high. So more population without a boom in housing will just raise prices again. And if the U.S. is returning to higher immigration levels, all the more case for the home builders, I think. Several participants assessed that healing in supply chains and labor supply was largely complete, and therefore that continued progress in reducing inflation may need to come mainly from further softening in product and labor demand, with restrictive monetary policy continuing to play a central role. Household sector, consumer spending had been strong. Participants mentioned several factors that may contribute to softer consumer spending, including slower growth of labor income and diminishing pandemic-related excess savings. Relatedly, many participants noted increased usage of credit by households, including from credit cards, buy now, pay later borrowing, and payday loans, as well as increased delinquency rates for many types of consumer loans. Well, that doesn't sound good. Whenever we have these petitions mention several factors, this is in each of the central bank districts. The central bankers do go out and they talk to different businesses. So this is stuff they're hearing firsthand. That's it's anecdotal, but when you start having, somebody from Richmond, somebody from New York, somebody from Chicago, somebody from Atlanta saying, I'm hearing the same thing, it starts, I think that is better data, even though it's anecdotal, really, it's better data, I think, than the aggregate numbers that you get. Regarding concerns about CRE, here it is again. Several participants noted a significant share of properties would need to be refinanced in 2024. This is true, against a backdrop of higher interest rates, continued weakness in the office sector, and balance sheet pressures faced by some lenders. So I wonder if that is going to be the thing in 2024. 2023, we had a banking crisis where it was highlighted that, hey, listen, some of these regional banks have a lot of these CRE loans on them, and now we're paying attention to the CRE loans, and it is true. There is a lot that come due this year. Could this be the thing? Many noted that nominal wage growth had continued to slow broadly, and that business contacts expected a further reduction in wage growth. A few participants observed that payroll growth had slowed substantially since the beginning of the year. Some participants remarked that their contacts reported larger applicant pools for vacancies, and some participants highlighted that the ratio of vacancies to unemployed workers had declined to a value only modestly above its level just before the pandemic. So is the JOLTS data messy? Is it too messy to read anything out of? Is it sort of capturing just a slightly wrong thing? Now, I think it's capturing the right direction. Job openings coming down, quits rates coming down. But as has been pointed out several times, when a company posts a job, they might post it in 4 different ways, trying to find that unicorn that's out there. And they may post it in 4 different places or under 4 different titles, or under multiple different titles, or in multiple venues. That perhaps, one job listing turns out to be 12 different postings, so that it just could be overstated. But what we can have, I think, confidence in is that job openings are coming down. Even if we're measuring it wrong, if we keep measuring it the wrong way, we can at least get a trend. It is coming down, and the quits rate is coming down. Several participants noted the risk that if labor demand were to weaken substantially further, the labor market could transition quickly from a gradual easing to a more abrupt downshift in conditions. We got CRE that we got to pay attention to. We got labor demand that we got to pay attention to. It is Wednesday as I do this, because that is when this document came out. January 3rd, 2024, we got 2 days for the jobs report. Let's see what we get. Participants observed that after a sharp tightening since the summer. Now, this is the thing I talked about when we looked at real rates a little while ago in the market outlook. I said we got to watch these real rates because if these real rates start to fall too low, that is a loosening of financial conditions precisely when the Fed doesn't want it to happen, and it could delay rate cuts even longer. Participants observed that after a sharp tightening since the summer, financial conditions had eased over the intermeeting period. Many participants remarked that an easing in financial conditions beyond what is appropriate could make it more difficult for the committee to reach its inflation goal. So the question is, with the market pushing real rates down, can inflation fall faster than they push real rates down? That'll be interesting. So there's another thing we got to watch. And later on, we'll see that we got to watch the level of the reverse repo. So there's 3 things we're going to walk away from here. What's going on with CRE? Actually, 4. What's going on with CRE? What's going on with these consumer credit delinquencies that we're seeing? Should we be watching rising delinquency rates? What's going on with the reverse repo? And how close is it getting towards the zero line? And this potential drop in the demand for labor. Downside risk to economic activity noted by participants include the possibility that effects of past policy tightening may be larger than expected, the risk of a marked weakening of household balance sheets, possible negative spillovers from lower growth in some foreign economies, geopolitical risks, and lingering risks of further tightening in bank credit. I think 2024, that would probably be the year of really tight bank credit in CRE. Is that going to cause any trouble? Relatedly, several participants noted that the weakness in gross domestic income growth relative to GDP growth over the past few quarters may suggest that economic momentum during that period was not as strong as indicated by the GDP readings. Because that is an identity, right? Aggregate output equals aggregate expenditure equals aggregate incomes. So that gross domestic product should equal gross national income. So we have 2 ways to measure the same thing. They're done in different ways. One of them is saying, it's not that great. The other one is saying, whoa, I can't even believe this. We're almost triple, at least 2.5 times trend GDP for the 3rd quarter. All participants judged it appropriate. All participants judged it appropriate to maintain the target range for the federal funds rate. In discussing the policy outlook, participants viewed the policy rate as likely at or near its peak for this tightening cycle, though they noted the actual policy path will depend on how the economy evolves. In their submitted projections, almost all participants indicated that, reflecting the improvements in their inflation outlooks, their baseline projections implied that a lower target range for the federal funds rate would be appropriate by the end of 2024. No surprise there. The summary of economic projections had 3 rate cuts on average, 3 rate cuts across all of them. The median was 3 rate cuts. Some had more, some had fewer, but the median was 3. A number of participants highlighted the uncertainty associated with how long a restrictive monetary policy stance would be needed to be maintained, and pointed to the downside risks to the economy that would be associated with an overly restrictive stance. A few suggested that the committee potentially could face a trade-off between its dual mandate goals in the period ahead. Remember, one of them is price stability, which is what they've been doing for the last 2 years, inflation. The other one is full employment. And they're saying that they could face a trade-off between these in the periods ahead. Several participants noted, here's the reverse repo again, several participants noted that amid the ongoing balance sheet normalization, there had been a further decline over the intermeeting period in the use of the overnight reverse repo facility, and that this reduced usage largely reflected portfolio shifts by money market mutual funds towards higher yielding investments, including treasury bills and private market repo. Several participants remarked that the committee's balance sheet plans indicated that it would slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level judged consistent with ample reserves. Not sure what that number is. I think Powell mentioned it was something like 1.5 trillion lower than where it is now. I forget the number, but there was some vague reference to where it was roughly. These participants suggested that it would be appropriate for the committee to begin to discuss the technical factors that would guide a decision to slow the pace of runoff well before such a decision was reached in order to provide appropriate advance notice to the public. That's going to be a question again at the next press conference. It was in the last press conference. Here it is in the meetings. There's going to be another question about when the balance sheet runoff will be. Okay, you've signaled that by the end of the year you got rate cuts. Let's start talking about the balance sheet runoff. When are you going to start signaling when that's going to happen or where that's going to happen? And that's it. That is the end of that one.